In New York City, I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Stock futures are higher as Wall Street gears up for a high-stakes speech from Fed Chair Jay Powell. Treasury yields are falling here early this morning because we've got some downward movement in yields. The 10-year just falling about 3 basis points. Yahoo Finance is going to have coverage of the speech in interviews with current and former Fed officials all day long with our Fed correspondent Jennifer Schomburger. She's live on the ground in Jackson Hole. So let's get right to it. The 3 things that you need to know to start your trading day. Yahoo Finance's Jennifer Schomburger, Madison Mills, and Rick Newman have more.
Fed Chair Jay Powell is set to give his annual speech this morning here in Jackson Hole, just a few weeks before Fed officials meet to consider what could be their first rate cut of this cycle. Investors will be listening for more clues on how much the central bank could cut rates this fall. Investors currently pricing in a 73% chance cut and a 26% chance of a 50 basis point cut.
And shares of NVIDIA are rising this morning after falling nearly 4% on Thursday, shedding $117 billion in value. Today's upside move comes as several Wall Street analysts reiterated their bullish views on the stock ahead of the chipmaker's highly anticipated earnings report out next Wednesday. Shares are up more than 13% in the month of August. NVIDIA has been a big driver of the market rebound since the sell-off earlier this month. The vast majority of Wall Street analysts are positive on the stock in terms of their ratings.
And Vice President Kamala Harris officially accepted the Democratic presidential nomination Thursday night, the final day of the Democratic National Convention. Harris vowing she would be a president for all Americans and emphasizing her own middle-class upbringing. She touted her economic agenda, which includes lowering health care, food, and housing costs. And she also took jabs at former President Donald Trump.
In many ways, Donald Trump is an unserious man. But the consequences of putting Donald Trump back in the White House are extremely serious.
Trump took to his Truth Social network during Harris's speech, in one post writing that Harris has no specific programs, all talk, no action. Why didn't she do it 3.5 years ago? Attention now turns to the first presidential debate between Harris and Trump. That's scheduled for Tuesday, September 10th.
Our top story this morning, stock futures rising ahead of Fed Chair Jerome Powell's key Jackson Hole address. Now, the annual meeting, it comes at a critical time as the Fed navigates balancing its inflation fight with some evidence of cooling in the labor market. Here with more, live on the ground from Jackson Hole, Wyoming, we've got our Fed correspondent, Jennifer Schomburger. Jennifer, this is what we've been waiting for.
It's what we've been waiting for, Brad. All eyes on Fed Chair Jay Powell in about an hour's time for any new clues on the path forward for monetary policy as he gives his annual speech here in Jackson Hole. The last time we heard from the Fed Chair on July 31st during his press conference following the policy meeting, he said the Fed was getting closer to cutting rates, setting the stage for the first rate cut in this cycle for September.
We think that the time is approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
The latest inflation report, the Consumer Price Index for the month of July, underscored the downward trend in inflation that resumed in the second quarter after what seemed to be a head fake in the first quarter that inflation was stalling. The Fed now has 4 straight months or more than a quarter's worth of inflation data trending in the right direction. At the same time, we've seen softening in the job market, and Powell said in July he does not want to see a material cooling in the job market. Powell and company have made clear that they are focused on both sides of the dual mandate, inflation and employment now, not mainly inflation. And a string of regional Fed bank presidents have made clear in recent days they are paying closer attention to the job market and they are open to a rate cut in September. Now, traditionally, Fed chairs have used the platform here at Jackson Hole to deliver an important policy message. Powell could use the platform today to open the door further and signal more clues for a rate cut in September, or he could take a step back and delve into a deeper research topic that may be germane to the current environment. Now, of all the Fed chairs over the past 24 years, dating all the way back to the year 2000, Powell has moved the market the most with his speeches here in Jackson Hole, pushing the S&P down 2.6% in 2019 and 3.4% back in August of 2022, the most of any Fed chair with that famous 8-minute short speech on doing what was needed to bring down inflation. We will hear from Fed Chair Powell at 10 a.m. Eastern right here in Jackson Hole. I will have those Fed headlines for you. Back to you.
All right, Jen, we're looking forward to that. And Yahoo Finance's coverage of the Fed's economic symposium, well, it's just getting started. It all kicks off, like Jen was just saying, under an hour with the speech from Fed Chair Jay Powell. That's at 10 a.m. Eastern time this morning. Jennifer is going to have interviews on the ground with former and current Fed officials, including former Cleveland Fed President Loretta Mester, former Fed Vice Chair Alan Blinder, and Philadelphia Fed President Patrick Harker. We also will hear from Atlanta Fed President Raphael Bostic, and we'll get reaction from the IMF and the White House. Quite the lineup coming up for you here on Yahoo Finance. Let's take a look at how stock futures are moving before we're getting the commentary here from Powell later on this morning. You got futures pointing to some gains here, at least on track to open the day in positive territory. You've got the Dow futures trading just to the upside. You've got the Nasdaq futures also some movement to the upside there. You can see it on the top hand or the top part of your screen there. When you take a look at the S&P 500 futures, that's also looks like we are going to open to the upside here. Now, just putting this in context for you, going back the last 10 years, the S&P has moved on average about 1.3% following Powell's remarks. So that has been a bit more reactionary when you compare it to the moves that we have seen over the past 10 years in the bond market. Right now, we have Treasury prices moving to the upside, yields under just a bit of pressure. When it comes to the behavior that we have seen in the 2- and the 10-year yield following Powell over the last 10 years, that average move has actually been less than 4 basis points. So right now, the options market not really pricing in too much of a reaction when it comes to equities. I was looking at notes here from Deutsche Bank this morning. They're not expecting too much of a move here on the heels of Powell. But again, very important to keep in mind if we do get any sort of surprise here coming up in an hour. Well, 73% of investors are now pricing in a 25 basis point rate cut at its September meeting. That's according to the CME's FedWatch tool. For more on what to expect, we want to bring in Michael Darda. He's Roth Capital Partners chief economist and macro strategist. It's great to have you here. So very much it looks like the market isn't anticipating any sort of big surprise. What about you?
Thanks for having me on. No, I don't think Fed Chair Powell is really going to want to rock the boat in terms of market pricing for this talk today. But my concern is that, the Fed moving 25 basis points at the end of September, that's almost a month away, is that going to be enough to offset the decline in inflation and inflation expectations that we've seen since the spring? And that would be the question I would put to the Fed if I were out at the Jackson Hole conference now. And I'd be very interested in the answer. But I think Powell's approach is going to be slow and steady. Don't rock the boat. He's mentioned the totality of the data, so he's not looking at one data point. And I think that puts the Fed in a posture where there's just not going to be a sense of urgency unless things change drastically in just under a month.
I'm not as good as Fed Chair Powell, so I'm going to look at one data point here, and it is the labor market. And from what you're kind of gathering from the different data points that are coming together, what is that spelling out about the labor market, and how do you suspect that Fed Chair Powell may need to acknowledge what's taking place there?
Yeah, no doubt about it. The unemployment rate has been moving up, not just over 1 month in July, but in a persistent fashion. And now we're up almost a percentage point from the cyclical trough in the spring of 2023. If you go back and look at what that means historically, it's always meant that the economy has fallen into recession. Now, a lot of people are saying, well, it's different this time because we have more growth in the labor force. Any way you slice it, however, it means the economy at a minimum is growing below the growth rate of potential if it's growing at all. And one big problem for the Fed here is that if you're at a turning point, if you're at a cycle peak or the very early innings of recession, GDP can be positive, payrolls can be positive. So this totality of the data approach, I think, can get the Fed into trouble. We see huge revisions in a lot of the data that folks are leaning on to say everything's fine. We're not in recession. Don't worry about the rising unemployment rate. The unemployment rate's actually one of the least revised economic statistics that we have. It's not a leading indicator, but it just might be the most robust coincident to slightly lagging indicator, and hence the most important for the entire U.S. business cycle.
So, Michael, I guess where does that leave then the probability of a recession in your view? Should the Fed then be considering 50 basis points if we are seeing some weakness here, material weakness maybe in some view, of the labor market?
Yeah, that's a great question. So I think the probability of recession is still quite high, even though you wouldn't know that looking at, say, the S&P 500, which has just been on this 2-year tear with a 3-week interruption not long ago. That's almost been completely reversed now. But equity markets can be optimistic right up until the end of a business cycle. So there's not necessarily going to be a bunch of lead time there in terms of what equity investors are doing. The unemployment rate moving up the way it has suggests that we actually could already be in recession. And that is a probability possibility. If not, I think we're dangerously close. And that means that the Fed is way too tight here. The policy rate's too high. I do think they should consider 50. Consider this. Bond market inflation expectations have fallen 60 basis points since the spring of this year. And that means with the policy rate flat, real rates have gone up by 60 basis points. So even a 50 basis point cut in September would only partially reverse that. And again, I would put this question to Fed Chair Powell if we spoke today. Does the committee really want the real policy rate moving up on net at a time when the labor market is losing steam and consumers are under pressure? So we'll see if we get that answer, but I'm not going to hold my breath.
And it's going to be fun to get back into the conversation about what the terminal rate on the cutting end of this is going to look like. What is your estimation for what we should expect there?
Yeah, great question. So, this is something that's very difficult to model. The Fed, has said essentially that they don't, have a tremendous amount of confidence on where neutral is. They're going to just see how the economy and financial markets perform and respond. I would say, what's a neutral rate for the U.S. economy if we're balanced out and, inflation at target, growth running pretty close to potential, probably somewhere between 1.5% and 3% nominally. And we're up at 5.3 right now. Futures markets don't expect the policy rate to get down into the threes until the spring of 2026. And that means that the Fed could end up behind the curve here. And that's how you lose the soft landing. That's how you lose the business cycle. There seems to be this perception on Wall Street among many traders that if the Fed cuts rates at any time for any reason, that's just bullish. It's up and to the right. The business cycle will be fine. Well, that flies in the face of recent economic history where policy rates came down more than 100 basis points on average before the start of the last 4 recessions. Now, that doesn't mean the Fed shouldn't cut rates. It means that there's no guarantee that the soft landing is going to sustain itself if the Fed is cutting, if they're behind the curve at the same time. And that's really my concern. And the bond market inflation expectations, plus the inverted yield curve, I think reinforce that. Even 50 basis points at this juncture would not completely disinvert the yield curve. Is that really a posture the Fed wants now as inflation gets closer and closer to target and the labor market continues to lose steam?
All right, Michael, that's very helpful for investors to think about here as we head into Powell in just about 45 minutes from now. Michael Darda, always great to have you. Roth Capital Partners Chief Economist and Macro Strategist. Thanks so much.
Thank you.
NVIDIA is gearing up to report earnings next week, and Wall Street, well, it's still feeling bullish on the AI darling despite some worry over potential delays of its Blackwell chips. Yahoo Finance's Madison Mills joins us now with more. Maddie.
Hey, Shauna. So if you saw the NVIDIA sell-off on Thursday and got a little bit worried, you're not crazy for that, right? It was a fairly substantial sell-off on Thursday. It made NVIDIA responsible for a third of the downward pressure that we saw in the overall Magnificent Seven basket, and it was the biggest laggard of the group. Now, Wall Street responding, saying keep calm and carry on for investors. A slew of big banks reiterating their buy ratings on NVIDIA, with nearly 90% of analysts maintaining a buy rating on the stock. You've got Citi, Goldman, and KeyBank among the banks that are maintaining that bullish view. So I'm going to go through some of the company takeaways, and then I'll talk about the stock and the technical side of things. So Goldman in particular focusing on how the totality of earnings that we've gotten so far does indicate an improved AI demand outlook from other big tech names. Think about the hyperscalers, your Amazons, Microsofts, Meta, who make up 40% of NVIDIA's revenue. All of those firms have talked about increased AI expenditures despite any concerns with the Blackwell chip delay. If these companies are still maintaining their robust AI spend, they're going to be focusing their expenditures on other chip offerings from NVIDIA that are a little bit more affordable. But if they're continuing that expenditure on their balance sheets and spending on NVIDIA chips, that is going to continue to be a positive signal for NVIDIA on a fundamental level. Now, from a stocks perspective, in a lot of these notes, there's this idea that sell-offs for NVIDIA are, quote, valuation correctors. These sell-offs are buying opportunities. This is something that so many of our guests for the past several years, honestly, have talked about with NVIDIA. If you are someone who has not had an opportunity to get in on this stock, perhaps when you see a sell-off, that might be considered a buying opportunity for you. Lastly, I want to prep everyone for NVIDIA's earnings. Let's say you listened to the analysts from Goldman I just talked about, and you're interested in getting in on NVIDIA. What can you expect heading into their earnings next week from a stocks perspective? The options market is pricing in a 9 to 10% move in either direction after earnings. That's according to Stuart Kaiser over at Citi. And if the earnings are positive, that means that NVIDIA could add $270 billion to its market cap. That is more than the entirety of a McDonald's to its market cap just off of its earnings. And lastly, let's say something happens, NVIDIA earnings are negative. Investors who've come on our show and analysts who've come on our show, Catalyst, have said to think long term. If you look at NVIDIA compared to the S&P 500, it is beating the S&P significantly by double and even triple digits. When you go to the 1 year here, you can see on your screen, NVIDIA is up 174% over the past year, and the S&P up just 28% in perspective there.
All right, Maddie, great breakdown there. We're going to continue tracking this, as we know you will as well. Thanks so much, Maddie. All right, Vice President Kamala Harris accepting the Democratic Party's presidential nomination. In her historic speech, she vowed to be president for all Americans and really honed in on the middle class. Take a listen.
We are charting a new way forward to a future with a strong and growing middle class, because we know a strong middle class has always been critical to America's success. We will provide access to capital for small business owners and entrepreneurs and founders. And we will end America's housing shortage. Donald Trump is an unserious man, but the consequences of putting Donald Trump back in the White House are extremely serious.
Former President Donald Trump quickly reacting to the speech on Truth Social, calling it all talk and no action. With 75 days left until the presidential election, what can we expect next? Here with more on this, we've got Yahoo Finance senior columnist Rick Newman here with the details and some very high quality weighted ceramic bobbleheads as well.
Yeah. Well, with the table is set now. We have the joyful warrior. That was Kamala Harris's way of characterizing herself and the Democrats' way of characterizing her. And Donald Trump, the angry old man. Maybe this will work again. I mean, there are a lot of Americans who are angry, so maybe they feel like Donald Trump is channeling their anger. But guys, we are finally through sort of the opening act here, and now we're getting into the home stretch, about 75 days until the election. And it is a dead heat. I mean, it is. I looked at the betting markets today, 49.2% for Trump, 49.2% for Harris. I mean, like, just as tied as you could be. So what's really gonna determine this thing during the next 75 days? We're going to have a debate on September 10th. I think that's going to get a huge audience. Donald Trump, people might have forgotten about this, he is going to be sentenced in September for convictions on 34 fraud counts in that New York trial. And then it's going to be a matter of how these two candidates best get their messaging across on what they want to do. So we heard Kamala Harris talking about what she wants to do for the middle class, but we didn't get too many specifics last night. We know what some of those are. She wants to find ways to bring down the cost of housing, address high food costs. And the real question is, I think at this point, who is going to be able to connect better with a very small number of swing voters in about 7 swing states.
And then, Rick, we also have the reports that RFK is expected to drop his bid for the presidential campaign. Do you see that at all really swaying? You talk about the fact, I just bring this up because the polls are so tight. Is that really going to have any sort of impact, or how should we maybe more, I guess, broadly be thinking about that in terms of the impact?
So today, yes, it does look like it will make a difference because so it's not just that he's going to withdraw, he's almost certainly going to endorse Donald Trump. And of course, he wants to stay in the limelight. He wants to get some kind of post or role in a Donald Trump administration if we have one. So that could bring some RFK Jr. supporters over to the Trump side, and that probably at the moment is a net gain for Trump. But that's today in August, and he's not going to be on the ballot, it looks like. So when voters look at the ballot, they're not going to see his name. So how much of a factor is that going to be when people are actually voting? Most people are going to be, if you're voting by mail, it's going to be late October or early November or going to the polls. Are people still going to be thinking, well, I really want RFK to be in the race, but he's not, so I'm going to vote for Donald Trump? He could be long gone in people's minds by then.
All right. Yahoo Finance's own Rick Newman. I don't think the tie is long enough on that one. We'll see.
I think you're right about that.
Did you put the Band-Aid on yourself?
Yeah, it didn't come with the Band-Aid. It came before, I got it before the assassination attempt. So I guess I can, it's healed, right?
It's, well, yeah.
It appears to be.
I'll take
had
the
that
Band-Aid
Marvel-like
off.
healing.
Brad, I will see if I can get a longer tie.
Okay. Yahoo Finance.
I'm going to be in my workshop over the weekend,
Yeah.
like an elf.
Thanks so much, Rick. Everyone, we're just getting started here on the Morning Brief. Coming up, we're counting down to the big speech at Jackson Hole. Federal Reserve Chair Jerome Powell speaks right at 10 a.m. We're going to bring you his remarks and expert analysis all morning. Plus, later this hour, oh yeah, I hope you're hungry, we're going to get another pulse on the consumer, this time from Kava. Shares rallying right now after an earnings beat. The CEO is going to join us in just a few minutes. We've got all that and much more coming up on the Morning Brief. Workday shares surging. The company saying it will increase profitability in the next 3 years. Workday also touting AI for cost-saving measures in its call centers. You're seeing shares move higher by about 12.5%. A few things that I imagine investors took away from this, and just looking at the earnings call here, the transcript rather this morning, there are a few things that I took away from this as well. Number one, the macro environment. They're saying that that's essentially consistent with their last quarter, and this is a company that has a little bit of exposure when companies moderate their headcount, because that means less seats that those companies are paying for. So that one thing that they called out in the moderation of headcount growth within their customer base. Also here, it's important to remember the renewal activity that this company relies on, and they're lapping some very strong renewal activity. And so that's going to be something that certainly is going to be on the mind of investors as it relates to the growth. They're saying that's going to be about 14 to 15% for Q3.
Yeah, I think the big reason, and you might be looking at the movement that we're seeing at least in the pre-market, trying to figure out why we did initially see the drop and why we now are seeing gains here ahead of the open. But all of it has to do with what you just called out in terms of that future growth and what we are expecting here over the next 3 years. Some of that commentary that we got from executives on the call certainly caused Wall Street at least to take a beat and maybe switch their thinking just in terms of what that growth story looks like for Workday going forward. A lot of this, or a lot of the excitement, I think, surrounding Workday relies on AI innovations, the tools and everything that are going to be rolled out similar to their competitors within the industry. So again, it's trying to figure out how Workday stacks up against those rivals right now. And at least it looks like from this early read that we're getting ahead of the open following the results last night and the commentary that we got, it does look like Wall Street at least a little bit more bullish on what those returns could look like here over the next couple of years. Let's take a look at Ross Stores. Shares are in the green, moving to the upside, up nearly, or just about 6.5%. The off-price retailer raising its guidance for its fiscal year, beating the street's expectations in the second quarter. Management saying that growth is driven by stronger value, resonating with their customers. So again, a very strong quarter here from Ross Stores, a continuation really of what we have seen almost across the board from these off-price retailers. We know consumers are under pressure because of sticky inflation. Many of them are trading down or trading in, to put it in the words of Walmart's executives. And because of that, these off-price retailers are standing to benefit. So Ross Stores is not alone. And this report really reminds me of what we heard from TJX just last week. They had a strong second quarter. Their sales rose 6% from a year ago. Again, so some of that consistency there just in terms of the outperformance and what retailers are doing well here within this macro environment.
Yeah, planning some for the third and fourth quarters, comparable sales growth of 2%. 3% on the top of the 5 and 7% gains respectively in 2023 here. If the second half of 2024 performs in line with these sales projections, earnings per share for the third quarter, that's projected to be in this range of $1.35 to $1.41. You compare that to the $1.33 last year. So some incremental improvement that investors are going to be tracking up against.
All right, let's quickly take a look at Intuit. Those shares are on the move. It's a big mover here, trending stock at Yahoo Finance. Taking a look at the results that we got out from the company, an upbeat full year forecast. They beat the street's expectations. That's thanks to its AI-powered offerings, fueling demand for its financial tools. Now, despite all of that optimism maybe that we are seeing in these headline numbers, you are looking at losses here ahead of the open. It's off just about 1%. So the reason as to why that is because we did see a bit of a revision when it comes to future growth. The company adjusting its long-term growth expectations. Analysts are now warning that that could potentially, and is right now, weighing on the stock, but they're saying this could continue to weigh on the stock going forward. The company now sees first quarter revenue growth of between 5 and 6%, about half of what the initial, more than half, less than half than what the initial expectations were for about 13.1% growth.
Yeah, a lot of that coming back to the desktop ecosystem revenue. They're expecting that to decline approximately 20% in the first quarter of fiscal 2025. However, they are expecting a return to growth in the second quarter. And so we'll be looking closely at that. Of course, the first quarter desktop growth outlook that reflects the changes the company that they had made to their QuickBooks desktop offerings. That was back early fiscal 2024, completing a transition here to a subscription model. All right. The opening bell is coming up. We're just seconds away here. I'm excited. Are you pumped? They're pumped.
Always.
Take a look at the USTA Foundation. Oh my gosh, it's time. It's that time of the year where it essentially feels like the end of summer. And why? Because the US Open is taking place. I mean, it's like the unofficial marker for the end of summer. However, it's a great event. I actually was just out there a couple days ago. Great events. Looking forward to the tournament here. You've got a company, as I've been stalling, trying to figure out how to pronounce their name. I'm going to say Actuate. Actuate Therapeutics, we'll say, is ringing the opening bell at the Nasdaq. Great bunch of folks there, too. They get some confetti as well.
All right, let's kick it over to Jared Blickray. Jared, lots riding on this open and lots of questions about exactly the type of market action we're going to see. Of course, that hinges very much so on what we hear from Fed Chair Jay Powell in just about 30 minutes.
Yes, a lot riding on this, but I want to point out something. Yesterday was kind of an ominous signal in the markets, and I'm going to show you a one-month chart of the S&P 500. Actually, let's make it 2 months so we can see the prior highs. Those are the record highs. We climbed within 1% of those highs, and we just sold off to the downside. And I just want to show you and point out this is called a bearish engulfing pattern because this big red candle here is engulfing the prior day's range. In fact, it engulfs the prior 2 days range. You take a look at the Nasdaq, very similar story. You look at the Dow, that story remains. Russell 2000, not so much. But my point is we have that, and we also have volatility on the rise. Here's that big spike. It was probably overdone to the upside, but things settled down very quickly. But now we're just edging up ever so closely here, just kind of day by day. It's not a huge amount, but it's something that we want to keep in mind. Also taking a look quickly at the US dollar, it is up. It's up for the second day, basically, but not doing a whole lot this morning. So let's move on to the sector action where we have tech and consumer discretionary. They are leading today, and in fact, chip stocks doing pretty well. Let's take a look there at the semiconductors. NVIDIA up 1.45%. Want to show you the chart on NVIDIA too, because NVIDIA is another bearish engulfing victim here. So we'll have to see. Powell could say something at 10 a.m. that gooses a market higher, but I would be wary here for any breaks higher that they could be simply reversed. So a bit of caution warranted based on the price action this morning, especially since we've seen all these defensive sectors. You look at the upper left, real estate, materials, discretionary, healthcare, staples, a lot of those defensive sectors this week.
All right, fire up the Yahoo Finance t-shirt printer. Throw a bearish engulfing pattern on there.
I'm all about it.
Jared, we got to get the merch started. Thanks so much, Jared. Appreciate it. We're less than a half hour away from Fed Chair Jay Powell's remarks at Jackson Hole today. We're speaking to a strategist on how the speech might impact markets. That's coming up after the break.
Stocks moving higher as traders await remarks from Fed Chair Jay Powell. That's in just about 25 minutes. We are seeing gains across the board, a bit of a bounce back from the declines we saw yesterday as investors really question what exactly we are going to hear from Fed Chair Jay Powell in just a few minutes, but also beyond that, what policy is going to look like here from the Fed in September and beyond, following those expectations of rate cuts starting next month. So let's talk about all that and more with Omar Aguilar. He is Schwab's Asset Management CEO and Chief Investment Officer. Omar, it's great to have you here. So let's start with maybe what the stock market wants to hear from Powell. Obviously, they want to hear a dovish tone. They want him to be open to rate cuts. And exactly, I guess the question now is the pace of the rate cuts beyond the September meeting. Do you think the markets are pricing in Fed policy appropriately, or are they still maybe a bit more bullish than they should be just in terms of what we will likely hear and see from the Fed in the coming months?
Yes, good morning. Obviously all the eyes are in Jackson Hole and, the speech of the chair, Jerome Powell. The way that we see it here is that the Fed went into a very aggressive tightening cycle that we think of the analogy of just taking an elevator to raise rates, pretty aggressively. But what you will probably hear, in the next few minutes will be that the Fed will probably take the tone of taking the escalator down. In other words, they will probably suggest that while things are starting to go their way and they see the benefits of having lower inflation numbers towards their 2% that they want to target, they don't necessarily see that there is a need for them to just be too aggressive in cutting rates. To answer your question, I think markets are hoping that they will be a little more dovish and a little more aggressive going into September. But I don't necessarily think that in the script that we're going to hear from Chair Jerome Powell will basically suggest anything other than they will start in September, but they will be at a slower pace.
And so with that in mind, I mean, you had previously said that the soft landing, and this was late last year, so things have changed quite dramatically since then. But you previously said that the soft landing seems like it's in the scenario, in clearly in view. What's changed since then?
No, we still believe that the soft landing is a more palatable and probable scenario that we will see in the economy. And this is in the context of what we have discussed about the rolling recessions, rolling recoveries, because, even at this moment, what we see in what it could be a confusing economic data, where we see that manufacturing, housing, labor market is starting to see the signs of weakness, the signs of deceleration. On the other hand, we still see that GDP growth, consumer spending, and in general, services sectors are holding up very well. So it is this part of rolling recessions that will probably save the path for a more soft landing scenario more than a really hard or even a recession.
So what is the rolling recession playbook for assets?
Well, this is the most interesting part of what we have seen over the last, several decades, I would say, because of this context of this cycle. Of these rolling recoveries, rolling recessions, we have been discussing with clients that the strategy in both equities and fixed income is one of those of barbell. In other words, you cannot just think about the fact that we're going to do a full expansionary recovery like we used to do in other recessions, because we don't know what parts of the economy and what parts of the market will recover first. What we saw even in July is that we saw that head fake of, small caps outperforming, specifically as people started to think about the volatility in the summer. That is a sign that we're in that recovery mechanism. However, if you look at the data, 2/3 of that outperformance of a small cap that we saw in July is now basically gone the other way. So it is this part where we continue to emphasize the fact that in this environment, there is no need to be a hero. It is probably better to try to still maintain positions in quality, maintain positions in areas where we have strong balance sheets for equities, and then start moving duration in fixed income so that clients can actually enjoy what is still have higher yields in bonds.
Omar, let's talk about real quick. We've got NVIDIA earnings out next week, and I bring that up just because in terms of the fact that we've heard from so many strategists, we've heard from analysts, just obviously about it being more of a bellwether here, more broadly speaking, for that AI trade, which has been so important to the markets. How critical is that earnings report next week for the broader markets?
Well, it's clearly, going to very anticipated, and I think a lot of exposure, across the industry is in these Max 7, and therefore, being these the last one to report, you will going to be a lot of eyes going in through, what may be the case. And I think the key part is that when you look at those mega cap growth names, their earnings have been actually pretty good. They've been solid, but they have been received by the market with a little less enthusiasm than what we had even earlier this year. And a lot of that is because, while the discussion has been on AI, and while the discussion has been on the amount of capital expenditures that has gone in terms of developing of chips, developing of AI, it is really the return on equity and the return on investments that hasn't been as mature and tangible as what the market seemed to be expending. So a lot of the emphasis we'll see going into next week will be more about earnings expectations and outlook. That as you may seen in the last few weeks, the majority of companies, including the Max 7, have continued to reduce the outlook going into next year. And a lot of that is in anticipation, obviously, of the economic slowdown. But in general, what I think is going to be expected by the market is to hear what is the outlook for AI and what is the demand for chips, going forward as people continue to spend money in AI technologies.
All right, Omar Aguilar, always great to get your perspective, your insight here this morning. Thanks so much for hopping on with us. Schwab's Asset Management CEO and Chief Investment Officer. Well, coming up, we are going to hear from Kava CEO Brett Schulman. He will join us on the company's latest quarterly results. We're seeing that stock move dramatically to the upside. He joins us right after the break.
Kava shares surging this morning, up more than 13%. The stock hitting an all-time high after its second quarter results signal consumers are still spending at the restaurant chain. Here to break down those results, we've got Brett Schulman, who is the Kava co-founder and CEO, plus Yahoo Finance's very own Brooke DePalma, joining us for the conversation here. Great to see you, Brett. Congratulations on closing the books on another quarter here. I mean, what is the main catalyst that you're seeing show up for Kava right now that's something for investors to marvel at as of this juncture?
Yeah, well, thanks for having me again. And it's really our compelling value proposition. And I think that's driven by our differentiated, unique Mediterranean cuisine, that cuisine where taste and health unites, meeting the needs of the modern consumer who wants to eat better but doesn't want to sacrifice flavor or fulfillment. And then how we deliver that cuisine in our multi-channel format and our experiential format. So you think about value proposition, and we hear a lot about the value wars, which we think is a bit of a misnomer. We think that those are price wars, and price is the cost. It's what you pay for something, but value is the worth of what you get. And we frame value as a combination of the quality of our food, our fresh ingredients, the relevance of our differentiated Mediterranean cuisine, the convenience in which you can access that, whether you want to order on the app, pick up off the shelf, or pull around to one of our 45 drive-through pickup lanes, or the experience you have when you engage with our brand and come into our restaurants and eat a meal in our dining room and experience that Mediterranean hospitality our team delivers.
Brett, you guys did gain income cohorts across the board this past quarter, especially low-income cohorts. How is Q3 shaping up now that these QR restaurants have introduced and really doubled down on those value deal bundles? What are you seeing in Q3 so far that gives you confidence to raise your outlook this quarter?
Yeah, we raised our guidance significantly, and it's a reflection of the strength we continue to see in the business. So it implies low double-digit comps for the remainder of the year. And I think going back to that value proposition, when you think about price increases, from the end of 2019 to the end of 23, we raised price about 12% during that time period. CPI grew at 18%. The Department of Labor has noted that fast food raised prices upwards of 30%. So for $1 or $2 more, often at parity, you can get a bowl of fresh Mediterranean food at Kava versus a traditional fast food freezer to fryer meal. And we're seeing people trade over and trade up to us.
Steak was really a big hit this quarter. Wall Street's really focusing in on that. What are your plans to launch additional LTO offerings or perhaps permanent protein in the near quarters?
Yeah, well, credit to our culinary team led by my co-founder and Chief Concept Officer, Ted Zino-Christos, really put our Mediterranean flavors on a tried and true fan favorite. And it was a gap in our menu, a beef option, so customers looking for that heartier steak option. And they're working on a deep pipeline of innovation that we look to bring to our guests over the next few years and bring them some new excitement and new ways to experience Mediterranean flavors.
Is steak bringing in a different customer?
I think it's bringing in new customers, and it's having existing customers visit even more often.
What do you make of, and you guys talked about the social media success that you've seen on the call last night. What do you make of the bowl culture that's really taking over, emanating throughout TikTok and Instagram? How do you lean into that?
Well, I think it's a couple things specific to us. One, within the 38 items on our line, we have over 17 billion combinations. So you can really build your meal to your personal tastes and preferences and really have food that's just an expression of the way you want to eat and the flavors you want to have. And then secondarily, it's, you think about how the options you have, like it just becomes food as culture and self-expression. And I think people are really gravitating to that. And it's a newer, more adventurous cuisine. Mediterranean is, we think we're creating the next large-scale cultural cuisine category. And so we do it in an accessible way where people can feel like an adventurous, aspirational version of themselves, and they're excited to kind of communicate that to their friends.
I have to say, I go crazy. I end up putting too many toppings. I need to stick to the curated bowls from now often. But employees and not robots is always the go-to for Kava's business model. But you are introducing this connected kitchen that has automation, has AI. How will this increase throughput? And do you expect less labor in the restaurants with this technology?
Yeah, we always talk about the term technology to enhance the human experience, not replace it. When we see technology kind of disintermediating human connection in our daily lives, we want a place that's able to fill that gap, free up our team members through the use of technology so they can deliver that great hospitality. So Connected Kitchen specifically utilizes camera vision and generative AI to detect the food being depleted on our serving line and cross-reference it with real-time sales information, historical sales data, weather data, event data, to then project to our grill cook or our team in the back prepping food what they should be prepping, what they should be batching to mitigate food waste, mitigate any out of stocks on the line, and take all that complexity off the mind share of our team members so again they can be forward facing, focused on that great Mediterranean hospitality.
So no less employees, the same amount?
No, we see, our mission is to bring heart, health, and humanity to food, and if we lost that humanity piece, I don't think we'd be living up to our mission.
We got to go, Brett. What's the next big protein? I just got to know. It's burning inside. What is coming to the Cava Bowls here?
We've got some great surprises and secrets that we're excited to bring to market. We'll come back and talk about it when we launch it.
What a tease.
Brett Schulman, Cava CEO, joining us on set here at Yahoo Finance. Great to see you, Brett. Thanks so much. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
We're just minutes away from Fed Chair Jay Powell's speech in Jackson Hole, Wyoming. Let's do a quick check of the markets ahead of his remarks. You're looking at gains across the board, a bit of a bounce back in early trading following some of the declines that we saw yesterday. You've got the Nasdaq leading the gains here so far today, up nearly 1%. You've got the Dow and S&P also adding to those earlier gains here this morning. And Brad, the big question here for investors is whether or not we're going to continue to see this momentum here to the upside, or the market able to hold on to those gains, very dependent on what we hear from from Powell in just a few minutes.
Huge question. We've got all 11 S&P 500 sectors in positive territory. That a bright spot here on today's trading activity. As of right now, things are being led by technology, up by a little more than 1% XLK. So we'll continue to track that, of course, going into and after, of course, the fireworks set to commence as we get the tick by tick alongside Fed Chair Jay Powell's comments from Jackson Hole, Wyoming. Let's also just take a brief look at the treasuries, if we may, as we've got the 5, the 10, and the 30-year up on your screen. They are all in the red. As of right now, we're seeing just 1 basis point move lower for the 5-year, 2 basis points for the 10 and the 30-year.
All right, coming up, we are moments away from Fed Chair Jay Powell's annual speech in Jackson Hole, Wyoming. Investors, you are going to be listening for more clues on how much, whether the central bank is going to cut rates in the fall and by how much. That is really the key question. That's next. That's coming up on Catalyst. We'll be right back.
Welcome back to Yahoo Finance. I'm Madison Mills alongside Shauna Smith. We are 30 minutes into the trading day. The market waiting with bated breath on one man, Federal Reserve Chair Jay Powell. His highly anticipated speech at Jackson Hole could help clarify the path forward for interest rates. Let's get a check on the market action ahead of his speech. You can see that live picture there. We are still waiting for him to come to the podium, but you got the S&P 500 holding on to gains up about 0.6%, and the Nasdaq up nearly 1% coming off of that downward pressure that we saw yesterday, Shauna.
Yeah, Maddie, the big question here for the markets is what we are going to hear from Powell just in terms of the degree of those rate cuts, whether or not 25 or even 50 basis points could be on the table given that jobs report report that we just got out last month. Let's get over to Fed correspondent Jennifer Schomburger. She's live at Jackson Hole. Jennifer.
Shana, Fed Chair Jay Powell will say the time has come for policy to adjust, making a rate cut for September a certainty. He says the timing. Powell now coming to the podium. Let's listen in.
Economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%, still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade. But labor supply remained constrained, and in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage, and inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023, and we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
That was the sound of the Fed pivot. You just heard from Fed Chair Jay Powell. Markets moving firmly to the upside off of the news, stocks at their highs for the day. You've got the Nasdaq up over 1%. It's looking nearly closer to 2% here. It's up over 1.5%. You got the S&P above 1% as well. You're also looking at yields down across the curve, looking at around 4 to 6 basis points of movement across treasuries here. You can see that downward pressure across your screen. But let's get to what Fed Chair Jay Powell had to say about the path forward.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Joining us for instant reaction and analysis, we've got Stephanie Lane, Hamrickberg, Chief Investment Officer, and Steve Sosnick, Interactive Brokers Chief Strategist. Steve, I'm going to go to you first. The Fed pivot, it's here.
About time. They were looking for it 2 years ago, and that disappointed the markets. We finally got it. The only question I have is, was anyone not expecting a Fed pivot? I mean, everybody. This has been priced in for some time. I was checking, the CME Fed Watch while we were doing this. We're still expecting. We were expecting a full cut already. The odds have seemed to have gone up a little bit, maybe 30% chance of a 50 basis point cut, but. It's great. He ratified what the market's thinking, but there's not a lot of big surprises either way in here, and it does tell us that we better be watching the data that comes down the pipe in the next couple of weeks.
So Stephanie, when we talk about the data that's coming down in the pipe the next several weeks, obviously a lot of that is very dependent on that next jobs print and what we are getting. We certainly just got a lot of commentary from Fed Chair Jay Powell talking about the cooling that he is noticing. He used the word unmistakable in his speech, but I'm curious whether or not you think, given the fact that gradual actually wasn't used within his commentary there, does that make a 50 basis point cut then at the next meeting maybe a bit more probable?
I really don't think so. I think the Fed wants to be measured going forward. I think if there is a 50 basis point cut, it's really a reaction to a poorer jobs number or some other economic data that really concerns the Fed and cause them to move further than currently priced in. I think as far as where we are with the data, I think the expectations are that we are seeing a little uptick in the unemployment rate, but the expectation from here is I think we can see some stabilization, and I think the Fed wants a measured pace going forward and not scare the markets.
Steve, let me go to you on the labor market here, because it seems that is, of course, the biggest risk, as you mentioned here. What do you think is the right number for the Federal Reserve right now to get in the next jobs report?
I think they want it no worse than what we saw before. There was some question in the last jobs report about how much of the payroll offset or the unemployment claims are related to temporary measures about Hurricane Beryl in Texas. Right. I think it'll be interesting to see how much of those reverse. Obviously, the BLS revision was a big surprise. You can't just wipe away 800,000 jobs. Mm-hmm. On the other hand, 800,000 jobs in an economy where 150 million people or so are employed is not a huge number. Mm-hmm. So I think, though, This is the problem. Does the market want a poor economic number so that it gets more rate cuts, or does the market want a good economic number so that people can afford to buy stuff and the economy hums along? When in doubt, I prefer to vote for a stronger economy. It's not so clear that everybody thinks that. I think that people really would rather rate cuts, which is a little tricky to be in, because sometimes you got to be careful what you wish for.
Steve, I want to play a quick bite that we got from Powell. He was talking about some of the risks that do remain, the fact that the Fed still has flexibility at this point, given the high rate that we do see. Let's listen to that, and then I want to get your reaction on the other side.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
So, Steve, how should investors be thinking about that? I guess just the fact that maybe this gives them a little bit more confidence in terms of the fact that maybe we won't see the dramatic moves or that type of volatility that maybe had been a little bit in terms of those that were, I guess, pointing to maybe sort of that skittishness that we have seen in the market.
I think it gives us some more confidence in the idea that they may not be they might not be as slow on the uptake if there's a recession looming that I think people feared. We all knew that they have plenty of room to cut rates. We have 5.25% Fed funds rates. There's plenty of room in there. But I think the concern was that they would be a little slow to utilize that measure. He's pretty much saying here that we'll break glass if necessary. But it's what he's not saying here is that we're going to do it prematurely. He hasn't really still given us a clue to the pace. So to me, are we looking at one, as Stephanie said, a rate cut every other meeting kind of thing, or are we looking at something more aggressive? And I think again, the aggressive is if we need it, and that could be a little bit tricky.
So Stephanie, we did get that dovish turn, obviously, but how do you manage your investments when you've got this backdrop that is currently slowing but could turn into slow on the heels of any data point?
Yeah, it's a tricky market, right? I mean, more recently we saw, small caps take off and then a complete reversal. You're wondering if the economy is going to slow so much that it causes a recession. So I think right now we're still in the camp that the Fed can orchestrate this soft landing. We haven't seen concerning economic data. So for our clients, we're telling them to stick with their plan. If they have money on the sidelines, we expect there is going to be some volatility coming up. So that's a good time to deploy that capital. I'd also say, stay measured and don't try to be whipsawed by these moves. I think there is going to be a catch-up trade. We've seen some of the laggards, the sectors that haven't been participating, not only start to participate as far as their stock prices, but you're also seeing the EPS growth there for this year and next year. So that's encouraging as well. So I would say stick to your plan. Look for some of these laggards that have strong balance sheets, that are growing their earnings, and still have some reasonable valuations.
Steve, we still don't have much clarity, though, surrounding the destination for rates, right? How much is that going to add to the volatility that we could see?
Well, I think that's going to add a lot to it because we remain data dependent. So, I mean, think about it this way: we've got Nvidia earnings, which are not a Fed event, but that's a volatility potential. That's got a lot of potential for volatility next week. Friday the 6th, first Friday in September, we've got jobs numbers, and based on Powell's comments, you got to be crazy not to be paying a lot of attention to that. Mm-hmm. Then we also along the way, we're going to have PCE, CPI, and PPI. All before the Fed meeting, which is about 26 days away, I think. This is the part to keep in mind. VIX, we talk about it as a fear gauge. It's not really. It's really the market's best estimate of volatility over the coming 30 days. By the way, we've had
15?
That's the thing. But we've had sequential 1% moves, right? I mean, today is volatility too. It's what I call socially acceptable volatility, but it's still volatility. Mm-hmm. And so I think the idea that volatility is behind us is wrong. I think it actually does, as Stephanie, I agree with her on this one, that we're going to, there's a lot of things that can bring volatility over the coming 30 days, mm-hmm. Over the coming couple of months. And so I think it's wrong to be complacent. You have to be very nimble and very wary of it. And that's why I think the most important dip to buy is probably VIX.
All right. Well, Steve Sosnick, always great to have you, especially here in studio on a day like today. And of course, our thanks to Stephanie Lang as well. Let's do a quick check of the markets here following Powell's commentary just moments ago. Taking a look at gains across the board, we certainly are seeing a rally on the heels of some of that dovish commentary that we got from Powell. You've got the Dow now up just over 400 points. You've got the Nasdaq still leading the way, up more than 1.5%. The S&P 500 also firmly above 5,600. More on that when we come back.
Federal Reserve Chairman Jerome Powell wrapping his remarks at Jackson Hole, nearly cementing a quarter-point September rate cut for the markets. Let's take a listen to what he had to say about the path forward for interest rates.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Still data dependent there, but the stock market trading on optimism. The Nasdaq up 1.8% and the S&P holding on to those gains up about 1.3%. But let's get to the broader market action with our very own Jared Blickery. Hey, Jared.
Thank you, Maddie. This was a risk-on event, even for Bitcoin. We'll see if we have time for that. Let's dial up the Wi-Fi Interactive and chart the day's price action. This is the S&P 500, and here is 10 a.m. when we got that big jump up. Also, I should mention, we got an unusually strong housing report. I think it was up 10%. It was just an outlier, and so that could factor in too. But I think the main show here is Powell, so let's stick with that. I do want to show you what's happened this week. This is a 5-day look, and you can see see here on a candlestick chart, we are just punching above yesterday's highs. And I was making a big deal on the open about this bearish engulfing pattern that we had yesterday. If we close above those highs yesterday, close above yesterday's highs, that is negated. So that would be very bullish for the market. Here's the S&P 500 equal weight index, and this is at a record intraday high. This is the first record intraday high that we've seen since the end of July. We had a record closing high a day or two ago. And then I want to show you the Russell 2000, which is also heading higher. Now, we were just talking about volatility with Steve Sosnick. This is a 2-month look. So here's that big peak that we had before. And I've been pointing out that we are just slowly inflecting. But here's the 5-day look. We are heading off of those highs that we had yesterday, down from those highs. And so that is kind of a risk-on movement. Got to show you what's going on in the bond market. I don't think we're done there. Let me switch to an intraday look. We can see the 10-year T-note yield down 7 basis points. And here's the 5-day price action. So we're not even quite down to the lows of the week, but that would be an important level to watch. Here's the US dollar index that has hit new lows for the week. And by the way, on a year-to-date basis, it is now underwater by 1%. Just going to close here by quickly showing you the sector action. It is all about tech and consumer discretionary. You look at the mega caps, that's where a lot of this strength is right now. Guys?
All right, Jared, let's talk a little bit more about the action more specifically that we're seeing within the bond market here, because we are seeing a move to the downside. You're taking a look at the 5, the 10, and the 30-year yield. For the 10-year yield, you're looking at a drop of just about 7 basis points, a move lower following commentary from Fed Chair Jay Powell that it does seem to be the time to cut rates or adjust policy going forward. So as the market digests all this, let's talk about specifically how the bond market is reacting, what this means for the bonds going forward. For that, we want to bring in Vishal Kanduja. He is Morgan Stanley's Investment Management's Senior Fixed Income Portfolio Manager. And Vishal, it's great to have you here. So our markets reporter, Jared Blickery, set up this question perfectly here for you, at least for me. When it comes to the movement lower that we are seeing in yields today, the 10-year off just about 7 basis points, but we're still not touching the lows that we saw earlier this week. Do you expect to see a further drop, and by how much?
Yeah, I think we do. Thanks again for having me on. Good morning. I think the market is clearly reflecting the confidence in data that Chairman Powell reflected in his speech. Data that shows a clear disinflationary trend at this point, and then recognizing the cooling of the labor market in the last 6 months. I think what this did was, I think, ratified the market pricing that, yes, September cut is here. Also keeps that optionality if they want to go 50. Again, they have another set of entire 1 month worth of data, whether it's the labor market or the inflation to look at. But then some undertones in that speech also very clearly pointed out that the focus is on labor market, focus is on the underlying pace will be now tied, or cutting will be tied to that labor market versus inflation going forward. That's what we heard. And then I think crux of the matter here is that I think very clearly recognizing and confirming that cash will underperform fixed income. I think if you look at the last 2 years, cash has underperformed or money markets have underperformed intermediate fixed income. And I think that path will continue on going forward for the next few years.
I'm curious, Vishal, given that the remarks were somewhat in line with expectations, though, to your point, Powell did not rule out a 50 basis point cut. Are you surprised about the rally that we are seeing in treasuries?
I think that surprise in the speech that is shown in the market reaction this morning is that pre-committing to that ratifying that path, what is priced in right now into the market, which was the question that the market and some of our investment team meetings also had was how much is priced in right now. I think we are priced in before the speech. We were about 100 basis points till the end of this year and another 100 till the end of next year. We did have our base case suggesting that the Fed will struggle to deliver on those 200 basis points of cuts. But now the market is, I think, clearly, pricing in the confidence that not only Chairman Powell, but then also the Federal Reserve Committee as a whole has in that disinflationary path. So definitely pricing in a lot more. And that is where the surprise comes in for the market and the reaction that we are seeing.
Vishal, when it comes to some of that commentary surrounding the weakness that we are seeing within the labor market, of course, that then begs the question, now that there seems to be a lot more attention from Fed officials on some of that weakening in the labor market, does that at all, I guess, change or alter your risk of recession and then further that movement there that we could see as a result in the bond market?
Not really. I think, I think the market is definitely pricing in a non-zero chance. I think maybe about 25% at least as of this morning, a chance of a recession in the next 12 months. I think our base case still remains of soft landing, if you will. I know it's a pretty cliche term, but soft landings are bumpy. Data is not giving you a very clear sign. And I think one big assumption here is also that we are very confident that the Fed has a lot in its toolkit to avoid that sort of hard landing, if you will, or a massive recession. We are moving away from a restrictive policy to less restrictive policy, not moving into very dovish or very easing policy at this point, because that is not what our base case is and not what the economy is actually warranting right now. So we are not moving into a recessionary time frame where the Fed is actually rushing to cut. Here, I think they are recalibrating. And I think this goes back to probably the soft landing that they've been guiding us towards. And I would say that the Federal Reserve central bank here and Chairman Powell can actually declare a victory a little bit here at the end of the year.
So if this is the Fed's victory lap, what does that do to your investment thesis? If you're talking to folks, where's the biggest opportunity across the curve if we are in that victory lap phase?
I think the 0 to 7, 0 to 10 year part of the curve is very attractive. I think that dual mandate of fixed income, I think one is providing that income in a client's portfolio, and then second being a hedge or bringing that negative correlation to the riskier part of your portfolio is proven again in the last 6 weeks of 3 weeks of volatility that we've seen, the volatility that we saw in risky markets around the regional bank crisis that we had we were getting into in the first part of 2023. I think that hedge capability of fixed income as well as the income capability, that dual mandate, is really evident at this point. And that's why if you look back the last 2 years, ending July 31, intermediate fixed income, that 0 to 10 year part, if you had like a 6 year duration portfolio, has outperformed a money market portfolio. So we do think that 0 to 10 year part, the steepener, if you will, in the portfolio should work really well.
All right, Vishal, we're going to have to leave it there. Thanks so much for joining us. Vishal Kanduja, he's Morgan Stanley Investment Management's Senior Fixed Income Portfolio Manager. We're going to have all of your markets action ahead. You're still looking at gains across the board, though, pairing some of the earlier gains that we saw, the Nasdaq up over 1.5% and the S&P holding on to gains over 1%. Stick around for more.
Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. The cooling in labor market conditions is unmistakable.
That was Federal Reserve Chair Jay Powell moments ago speaking from Jackson Hole, talking about the cooling of the labor market. For more on that labor market and his takeaways from Powell's speech, we've got Andrew Levin. He's Dartmouth College economics professor and former Federal Reserve Board special advisor. Andrew, it's great to speak with you. I want to start right there on the labor market because it is the biggest risk to the Fed moving forward here. What do you think could happen to the path forward for the Fed if we do get a surprise in the upcoming jobs print on September 6th? Does that increase the likelihood of us getting a 50 basis point cut come September?
Yeah, great. I think there are two ways the labor market can cool. One of them is lots of people losing their jobs. And that's happened in the past. We see it in the new jobless claims numbers when that happens. And that's driving, those layoffs drive up the unemployment rate. That's not what we've been seeing for the past year. In fact, yesterday's report's consistent. The new jobless claims yesterday was around 230,000. That's about where it was a year ago, not too different than where it was in 2019 before the pandemic. So there's not massive layoffs happening. So why is the unemployment rate going up? How is the labor market cooling? And the answer is a lot of people are joining the labor force. And in particular, when you look at people 25 to 54, it's been amazing over the last few months that the number of people in that age group, the kind of core, we call them prime age workers, joining the workforce, looking for work. Now, why is that happening? Well, it's because people's pocketbooks are tight. Prices have gone up a lot. Wages haven't caught up with those increases in prices. And so families need to have more hours of work in order to meet their expenses. So the labor market is cooling, but it doesn't look anything like a recession, certainly not a standard recession.
So then, Andrew, I guess my question is, how do you see the Fed then factoring that into their future policy decisions, just given the fact, and Powell talked about it, just the supply dynamics and why it is so different than what we had seen in the past. And then I guess to piggyback off of that, what does this then do, I guess, your overall impression of the speech and the confidence that Fed Chair Jay Powell still seems to have that they are going to be able to pull off a soft landing?
Okay, great. I think the first thing is I would be extraordinarily surprised if the Fed cuts rates by 50 basis points next month. Mm-hmm. I just did not hear that at all in Chair Powell's speech this morning. The words he used was there's ample room for easing, and that the Fed is strongly committed to supporting a strong labor market. He didn't say that the economy is about to plummet into recession, that they're not in emergency mode, which usually would be the case where they start making really forceful, large, extraordinary cuts. This is not emergency, it's a pivot. And so I think what's probably coming is a quarter-point cut at every meeting for the next 4 meetings in a row. That would cut a percentage point. Mm-hmm. And then they'll start to see, as they have in the past when they've done either a normalization cycle, usually it was raising rates up. In this case, it's bringing them back down. So it could end up being a full 2 percentage point cuts. That would be 8 meetings in a row of a quarter point each, and maybe a pause here or there. So that means 8 meetings from now would be basically the middle of next year. The federal funds rate could be 2 percentage points lower than it is now if they continue to see inflation subsiding to the target and the unemployment rate is close to where it is now. Maybe more people join the workforce. Maybe some of that levels off. The critical thing, the reason why the Fed needs to ease rates is so that those people can find jobs. We want a strong labor market. We want families to be able to meet their expenses. That's part of the Fed's mandate, along with price stability, is to support full employment. And so I think there's definitely ample room for them to support a strong labor market right now.
Andrew, given that you have been an advisor on the Federal Reserve Board previously, I want to get your take on some advice for the Fed. I know you'll remember 30 years ago when Bernanke said that central bankers are firefighters. They're fighting the fire right in front of them. If the Fed is so data dependent, are they potentially missing the forest through the trees because they're so focused on what is right in front of them and maybe not looking ahead to potential further economic risks that could even include a reacceleration of inflation down the road?
I think that there is certainly a risk that we have a false dawn with inflation. A lot of the improvement in inflation's been on the good side. Rental rates, for example, in the housing market are still strong. And by the way, this morning's new home sales report was great. Sales up 20% over the last 2 months. It's a big revision, and some of that could be revised again. But it looks like things are going better in housing construction. But house prices are high, rental rates are still going up, and that could potentially feed into other kinds of inflation over time. So the Fed's got to keep an eye out, be attentive to those risks. But probably, as Chair Powell said, there's ample room right now to move toward easing policy to support a strong labor market. And as I said, I think my base case is that they cut a quarter point per meeting, starting at this coming meeting. They'll use language in the next statement kind of along the lines of they're going to be continuing to ease gradually as long as the data is consistent with that. But they got to be attentive to the risks.
Andrew, we heard real quick, we only have about 30 seconds here, but Powell was talking about that that Fed officials need to rely on lessons that have been learned when they're applying that to the future strategy and some of those future challenges. I'm curious from your perspective, obviously following this all very, very closely, what would you say is the biggest lesson learned at this point?
The single biggest thing that they could do to improve right now is to start doing scenario analysis and contingency planning. I've called it stress tests for monetary policy. And that would become part of their public communications to explain where do they see the risks, what kind of risks, how big are those risks, how would they respond if those risks materialize. The Fed's never done that before, at least not in their public communications. It would be helpful. It's like a weather forecaster talking about where the hurricane might hit, or a medical doctor, a team of physicians sort of talking through, here's what we think given what we know now, but here's what could happen, and here's how we would respond to that. And that helps the patient and the patient's family to stay calm and to get healthy.
All right, Andrew Levin, always great to get your insight. Thank you so much for taking the time to join us here. Dartmouth College economics professor and former Federal Reserve Board special advisor. Thanks, Andrew. Well, coming up, the other big story that we're watching here at Yahoo Finance, Democrats wrapping up their Democratic National Convention, culminating with an acceptance speech from Vice President Harris. We're going to talk about the state of the race next.
Vice President Kamala Harris closing out the Democratic National Convention last night with a rousing speech. She laid out her economic vision for the next 4 years. Let's take a listen.
That's why we will create what I call an opportunity economy where everyone has the chance to compete and a chance to succeed. And as president, I will bring together labor and workers and small business owners and entrepreneurs and American companies to create jobs, to grow our economy, and to lower the cost of everyday needs like health care and housing and groceries.
For more reaction to the convention and where the election stands with less than 75 days to go, we are joined in studio by Tom McLaughlin, UBS Global Wealth Management's Election Watch co-lead. And Tom, it's great to have you. Thanks for coming on set with us.
Being here.
Let's talk about your election probabilities. They've changed quite a bit, which we will talk about. But talk to me about your most likely outcome right now and what your models are telling you.
The most likely outcome today, and it's today, not 7 weeks ago, is Harris actually winning. But it's by a very, very small margin. This is going to be an exceptionally close election. So when we talk about probabilities, we're very careful to suggest and tell our clients this is going to be a nail biter right to the end, right to election day. So Harris by a small margin is probably more likely. In terms of the Congress, which is equally important, how Congress comes out of November is going to basically dictate domestic policy. And what can be implemented and what simply can't be implemented. And in that case, we think that a divided Congress is just as likely as a unified Congress.
So then what does that mean just in terms of implications for policy, implications for markets more specifically, and the economy, if we do have that outcome?
Right. A lot will basically depend on what your principal concern is. If, for example, your principal concern is the size of the federal deficit, then you probably want to see a divided Congress. Because a unified Congress under either Republican or Democratic control, along with a Democratic or Republican president, is more likely to basically increase the size of the deficit quickly.
Are you telling clients that I guess in your conversations with clients, I'm
Sure.
sure they're asking you, what is the best outcome for me? What does this mean for my portfolio? Is there a straight answer to that?
The way you've asked it, probably not. but what we do say is, listen, there's a lot of evidence to suggest that presidential elections do have an impact on the market in a tactical basis, in a short-term basis, over the course of 2 or 3 months. Over a 2 or 3 year period, it tends to wash out. More, and this is equally important, if you're in a position where, here's the evidence, in 2008, those who were disappointed with the election in 2008 pulled out of the market. They went risk off, they reduced their equity holdings and missed the rally that happened beginning in March of 2009. Same thing happened 8 years later. Those who were disappointed with the election results in 2016, right? They also went risk off and they missed the rally in 2017. So what we're suggesting is it's really important not to get too wound up about the outcome of the election. It's hard to do given the media input and all the attention that we're basically focusing on the election. But for private clients, not tactical private equity, hedge fund, et cetera. But for private clients, construct your portfolio, stick with it, and don't get too wrapped up in the election.
What changes that advice? Because if you look at, I know you look at all of this, right?
Yeah.
But if you look at the stock market, it goes up regardless of whether you got a Republican or a Democrat in office. So what changes the advice to hold steady?
Okay, to that point, this is the other thing. I get a lot of questions from people say, who's better for the economy or who's better for the markets? A Republican president or Democratic president. It all depends on your time series. Do you start in 1928 or 32? 48 or 1960? Do you include or exclude 2008? Right? You can make the numbers do whatever you want.
Yeah.
So that's what's problematic and why we also emphasize, listen, don't get too caught up in the party affiliation. There are policy implications, there's no question. When you think about the two parties, look at what the Republican platform is today, right? It's immigration skepticism, it's border protectionism, it's economic populism, lower taxes, lenient regulation, and I would call it transactional isolationism. That is being wary of foreign entanglements. The Democrats, actually there's a choice here for voters. The Democrats are saying multilateral engagement. We want to basically work with traditional allies. Targeted taxation, we're going to basically have the tax code target for the benefit of those who are not doing quite as well as others. There is a social progressivism app to this, which is reproductive rights, child tax care credits, family leave. So I sometimes get the question from individuals saying, do I really have a choice? There is a choice here. which is positive from the perspective of everyone should vote.
What is the lead up to this election? Obviously, with Biden stepping aside, you have Kamala coming in late. How is it evaluating these policy perspectives in that this year? How has that differed from the work you have done in the past? I guess, does that further complicate or add maybe a little bit more uncertainty given the fact that we haven't necessarily gotten much clarity? And I think you can make that argument for either candidate.
Yeah, it would have been more challenging if Biden hadn't endorsed as vice president and Harris wasn't anointed by the party as his successor. Because to some degree, she is going to be somewhat constrained as to how much distance she can make between herself and Biden. Right. She'll create some, by the way. That's what new presidential candidates always do. But it's going to be more difficult to just basically move abruptly away from the policies. So what you're seeing, and what we saw in 4 days of the convention, is a lot of slapping each other on the back because of whatever successes they can basically suggest Biden accomplished. Very natural. In the case of Trump and J.D. Vance, they're suggesting that a lot of these successes were ephemeral and that we should go back to what they were doing 4 years earlier. But this is fairly typical. The one important takeaway I would suggest is that presidential elections are decided on the economy. And how pollsters ask the question make a difference. Sure. So in the middle of COVID, or at least shortly after COVID began in 2020, individuals were asked, what's the most important thing on your mind? And not surprisingly, people said COVID-19, right? When they asked what's the most important factor in your choice of president, they basically said the economy. Same time, two different questions asked slightly differently, and it gives you the impression that the economy is still going to dictate the results.
It's fascinating. Well, Tom, hopefully we can have you back before the election here over the next couple of months. Tom McLaughlin, we really appreciate you taking the time here. UBS Global Wealth Management's Election Watch co-lead. We'll take a look at the markets here following some of the dovish commentary that we got from Powell just about an hour ago. You are seeing gains across the board, although we are well off the highs of the session. You now got the Dow up just about 340 points. The Nasdaq still continuing to lead that rally to the upside, now up just about 1%. Well, don't go anywhere. Our Fed correspondent, Jennifer Schomburger, she's live on the ground at the Jackson Hole Economic Symposium, and she is speaking with former and current Fed officials, including former Cleveland Fed President Loretta Mester, former Fed Vice Chair Alan Blinder, Philadelphia Fed President Patrick Harker, and Atlanta Fed President Raphael Bostic. We will also get reaction from the IMF and the White House. Quite a lineup for you. That's all coming up next on Wealth. Have a great weekend.
Welcome back to Yahoo Finance. I'm Brad Smith, and we have a special report of the Federal Reserve's Economic Symposium in Jackson Hole, Wyoming. Fed Chair Powell saying the time has come for rate cuts. We have a big lineup of interviews for reaction. Our very own Fed correspondent, Jennifer Schonberger, is live on the ground in Jackson Hole, Wyoming. We're just moments away from Jennifer's interview with former Cleveland Fed President Loretta Mester. Later on in the hour, we're going to hear from former Fed Vice Chair Alan Blinder, and then as well, you're going to hear from Philly Fed President Patrick Harker. All that and much more. Plus, later on in the afternoon, we'll sit down with Atlanta Fed President Raphael Bostic, IMF Chief Economist Pierre-Olivier Gourinchas, and then additionally, you've got the White House Council of Economic Advisors Chair Jared Bernstein. Packed lineup here for you on Yahoo Finance, so stay tuned throughout the day. But first, let's do a check of the markets here. Stocks are higher. Investor sentiment getting a boost off of the back of Fed Chair Jay Powell saying that the time has come to adjust rates. To discuss what we've heard, we're heading on over to Jackson Hole, Wyoming, where our Fed correspondent Jennifer Schonberger is standing by with former Cleveland Fed President Loretta Mester. Jennifer, take it away.
Thanks so much, Brad. Loretta, thanks so much for joining me here in
thanks
Jackson
for having
Hole.
me.
It's great to see you.
Great to see you
It's so
too.
strange to call you former Cleveland Fed President.
I know.
So we heard from Jay Powell this morning, and he says the time has come to adjust policy. How do you take that? 25 basis point rate cut, a done deal next month?
Well, I think he was pretty clear. And in fact, he was actually pretty clear in the press conference after the July meeting that this is where policy is heading. And frankly, the case is pretty strong for beginning that process of bringing rates down. Now, this is not, easing policy to be, very accommodative. It's really reducing the degree of restrictiveness. And the case is basically because inflation has come down, right? We're in the 2.5% range now. And the labor market is moderating. That moderation in the labor market is something that we wanted to see because it would get supply and demand into better balance, and that's happening. So, the Fed has to be forward-looking with its policy because policy actions today affect the economy 6, 8, 9 months in the future. So it's really, where's the economy headed? And is this the time now to start that process of adjusting policy? So we're in that phase now, and I think he made it pretty clear that it's pretty clear that's the trajectory. Of course, he was mute on sort of the size of the first cut and 25 versus 50, which I know the financial markets are very, focused on. But in some sense, that's not the right question for this period. It's really about now we're starting a new phase, and the policy is going to be brought back down. The pace and the size of the cuts are really going to depend on how the economy actually evolves going forward.
So in terms of the path forward for policy, he did say that the outlook is going to depend on the incoming data, the balance of risks. You just retired from the Fed in June. I mean, you were voting in the middle of June on FOMC decisions. How do you see the path as we go through the fall and the pace of this?
Yeah. So I think a reasonable sort of baseline would be doing 25. I wouldn't want to start with a 50 because I think that is really a signal that maybe the Fed is behind the curve, and I don't believe the Fed is. I think the Fed has been very careful about really focusing in on the price stability mandate when that was the dominant focus, right? So when we started raising rates, and I can say we because I was on the committee at that point, right? When we started raising rates, it was clear that inflation was way too high, and the labor market was strong at that point. So it was very clear we focus on the price stability part of your mandate. Now, as inflation has come down and labor markets have moderated, it's really looking at both parts of the dual mandate and sort of balancing that. So the real challenge for the Fed going forward is, continue the momentum of getting inflation all the way back down to the goal of 2%, at the same time keeping labor markets healthy. And that's the balance. So as inflation's come down, the risk to that part of the mandate has come down. But as labor markets have moderated, that risk is growing. And how do you keep them in balance? And that's why it makes sense to sort of be methodical about and being deliberate about sort of reducing the degree of restrictiveness, but being attuned to sort of how the economy is evolving and keeping the policy in sync and calibrated well to the economy. When we started raising rates, policy was not calibrated well. And so the Fed had to, go pretty aggressively. But even at that point, right, the Fed started with a 25, then a 50, then did the string of 75s. Here, right, the desirable path, I think, would be to do several 25s.
And is
but
that
of course,
quarterly? Is that every meeting, every other meeting, quarterly?
I mean, I could see the Fed, in my forecast for the economy, could easily say the next 3 meetings we're bringing 25s. We're going to bring.
So every meeting they could go 25.
I could see that happening. That would be aligned with sort of where things were back in March. Remember when the Fed came out with their SEP, the median path was 3 cuts this year. So, where the economy is, and given the speed which was inflation came down faster than the Fed was expecting. I could see that happening. But again, it's going to really matter on how is the economy evolving and what is the whole, and when we say data dependent or the Fed says data dependent, I think sometimes it's misconstrued as like each data report and you'll see the markets gyrating. But really it's like, what is the data telling you about the outlook?
Right.
Because that's we have to look forward. We have to be really looking where the economy is going, not just where it is today.
How much of the change in policy path now, we're now entering a new regime, as you said, and it's more about not just we're cutting 25 in September, it's about the path of policy. How much of this is to ensure that economic growth continues and that we avoid a recession? Chair Powell seemed to be very fervent about staving off any weakening in the job market. That seems to be the new focus now. They seem to feel that, to your point, inflation is sustainably coming back to their 2% target. It's on the right path. They don't think that the job market is inflationary at this point. What's your sense of the economic outlook, why they're moving now, and the job market?
No, I think it is about really balancing both parts of your mandate, right, and balancing the risks around them. And, the job market is still healthy, right? And the key is, can we get to 2% inflation, keep the job market healthy, and calibrate policy to achieve that? And I think that's what this is about now. And it's sort of making sure that you don't allow policy to get behind or get ahead of itself, and keeping it in tune with where the economy is headed, keeping that dual mandate, right, firmly in focus. And I think that's kind of the challenge going forward.
Do you think we will achieve the soft landing?
Well, I think we have a good shot of it given where things are, but that's what you have to be attuned to, and you have to be viewing other scenarios that are possibilities. There could be shocks coming that we're not anticipating. There are many things that can happen in an economy. And so that's why you always want to make sure that your policy is well calibrated so that, right, you're in a good position. If things evolve, if suppose something happened and inflation started moving back up, policy right now is in a good place. Or suppose that the labor market, the moderation begins to become deeper and more weakening, policy can then adjust, right, and then the Fed could bring down the policy rate faster than anticipated right now. So again, you have to be sort of keep yourself in a position so that you can adjust, right, for the risks that may happen.
On the job market, we've seen the unemployment rate jump by 0.5 percentage point from its low over the past year. We do know that a big part of that is because more people are entering the labor force, trying to find jobs, as opposed to layoffs. Nevertheless, typically when we've seen that jump, the unemployment rate starts to move much higher, faster, and the economy has entered recession. So my question is, can the labor market continue to cool without a recession?
It will probably continue to cool a little bit because, we haven't seen it get totally back into balance. However, right, that's why those risks have gone up on the labor part of the mandate. So that's why the Fed has to be very attuned to what's happening in the labor market. It's still a healthy labor market. And yes, the unemployment rate has gone up, but it's still a low unemployment rate from the point of view of historical. But, we want to keep the labor market healthy. That's a very important part of a healthy economy, is the labor market. And so that's what the challenge is. Let's get back to 2% inflation, but at the same time, keep that labor market healthy. And I think it's achievable, but that's going to be a challenge going forward, is to make sure that they calibrate policy for that outcome.
We are in an election year this year. Donald Trump has said the Fed should not cut rates before the election. Looks like they're going to cut rates in September, as we've just talked about. How do you think a rate cut in September impacts the election, if at all?
Well, I'll tell you, I've been, a Fed person for many, many, many years. And I can tell you, and I've gone to many, many FOMC meetings. The politics does not enter that room, right? The Fed is very focused on its dual mandate goals when it's setting monetary policy, and only on its dual mandate goals. And the best thing the Fed can do is what it does all the time, which is take into account what's happening in the economy, what the data is telling you about the outlook for the economy, what the risks are, and setting policy based on that to achieve over time the dual mandate goals and to maintain it once you've gotten to the dual mandate goals of maximum employment and price stability. So we don't consider, or the Fed doesn't consider, right, the political situation. And in fact, that's important because having an independent monetary policy, everything that you read, all of research, right, has shown that that actually yields better economic conditions for the country.
Loretta, thank you so much for your insight. It was excellent. So appreciate it.
Oh, thanks for having me.
Look forward to talking to you again soon.
Thanks.
That's Loretta Mester, former president of the Cleveland Federal Reserve. Brad, I'll send it back to you in New York.
All right. Our thanks to our own Jennifer Schonberger and Loretta Mester, former Cleveland Fed president. Thanks so much. We'll have much more to come from Jackson Hole in just a little bit. In the meantime, stocks are higher as Fed Chair Jerome Powell says that it's time to start cutting rates, essentially. Here with me now is Yahoo Finance's market domination co-anchor, Julie Hyman. Julie, we've been keeping close tabs on what Fed Chair Jerome Powell had to say and the market reaction as well right now.
Yeah, and the consensus seems to be the pivot is here that the market has been waiting for, right? And so that's why we're seeing this market reaction. Now, you could say, well, we already knew, or at least strongly suspected, that this is what we were going to get from the Fed chair. But the confirmation and the clarity, to use the words of Loretta Mester just a few months ago, he was pretty clear, she said. The clarity with which he delivered the message is what seems to be sending the markets higher. I've been sifting through a lot of different commentary in reaction to this. Just got a flash note from Krishna Guha, who's the vice chair over at Evercore ISI. And this quote from him stood out to me. He says, with this speech, Powell nailed his colors to the mast on the soft landing. And while what is warranted in terms of rate policy to underwrite this will be influenced by incoming data, we think it confirms that if Powell ever thinks there's serious risk the soft landing might slip away, he will err in the direction of responding forcefully, sort of tying Powell's legacy to the idea of the soft landing. And this also speaks to the idea of now what is the question for the markets? Although Mester kind of said this wasn't the big question as to how much they were going to cut in September and what the cadence was going to be. But it does give Powell the flexibility, right? You know, we may not be saying data dependent anymore, but that's effectively.
Sure.
They're still data dependent.
You know, he'd much rather it perhaps be tied to pulling off that soft landing rather than the good ship transitory,
right.
As he had quipped
yes.
and joked, got a few laughs in the room as well here. And I mean, it's very mindful of himself to even mention that and go back. But one of the other things that we heard him talking about was the state of employment here in the labor market. Here's what he had to say.
So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable.
And we wanted to pull that clip because it's so telling as to the employment situation and how it passes through to the consumer mindset, which is a direct corollary for inflation as well, that the Fed is continuing in its dual mandates to tamper down.
Well, and again, it's a confirmation that the pivot is not just in policy, it's in focus from the Fed. Neil Dutta of Renaissance Macro put this well in a note. He said the balance of risks, as we've argued for a while, has now changed. There is a higher risk of rising unemployment than rising inflation. We know this. This is something we've been talking about with market participants for a while here. But again, just a further confirmation from the Fed. The inflation battle, if not won, is not as much a concern. the labor market is where the Fed's focus is now.
Absolutely. Been looking at the market's reaction as well after this speech.
Yeah.
Market's rallying right now. We really only have one sector of the S&P 500, 11 sectors that's in negative territory, and that is consumer staples. But as we had seen going into this, technology was one of the leaders. Real estate right now is the leader. It's up by about 2%. So we'll continue to track that as well in this rally mode that we're seeing after Fed Chair Powell's commentary from Jackson Hole. Julie, thanks so much for hopping on well.
Yeah, my pleasure.
Appreciate it. All right, coming up, everyone, more Fed coverage from Jackson Hole, Wyoming. Our Fed correspondent sits down with former Fed Vice Chair Alan Blinder, and Philly Fed President Patrick Harker. Plus, we're also going to have the conversation of rate cuts coming with potential relief in the housing market. We'll talk about the trajectory of mortgage rates. That's next, right after the break. Our Jackson Hole coverage continues at 11:30 a.m. Eastern Time. We're just a few minutes away from that. Here are some live images from Jackson Hole. You can just feel the crisp air as you take a look at what I believe are some horses and some good friends making their way over the hills. Anyway, they're over yonder. We're going to turn now to the housing market. Shelter costs have remained a sticky area of inflation, and elevated interest rates have kept mortgage rates high. But mortgage rates slipped again this week, staying below 6.5%. That's a positive for potential home buyers and hunters there. But lower rates means more competition for home builders. To break down what this all means for you, to make sense of it, we've got Yahoo Finance's housing reporter, Danny Romero. Hey, Danny.
Brad, builders over the past few years have been in a hurry to build as many homes to address the housing shortage in the resale market. But now inventory for both new and existing homes is rising and heating up some competition. For example, some of the publicly traded home builders like Meritage Homes, the 6th largest home builder, reported a lighter order count this quarter. Customers have been hesitant, which pushed Meritage to cut their average sales price by 6% compared to a year ago. And even though house hunters remain cautious, builders remain optimistic that demand will snap back as there still remains an undersupply of homes. In recent weeks, we've seen some sellers venture back into the market as rates have come down, with total housing inventory increasing 4.7% at the end of July, the National Association of Realtors reported. Now, what this could mean is that builders will have to really think a bit harder this time on how they're going to approach buyers in this new housing dynamic. Brad?
Thanks so much. We're going to continue the housing conversation here with our next guest. Sticking with the housing market, July home sales numbers coming in at 739,000. That's a month-to-month increase of over 10%, as lowering mortgage rates seem to be showing increased demand. These numbers are on top of existing home sales, which grew 1.3% in July, stopping a 4-month sales decline. This according to the National Association of Realtors. For more on the latest data print and looking ahead to what a potential September rate cut could mean for the housing market, we're joined by Lawrence Yun, who's the National Association of Realtors chief economist. Great to see you as always and have you on the program here with us, Lawrence. First and foremost, let's start with the latter part of what I just mentioned in that intro, which is what happens to the housing market if we finally do get the rate cut that not just the equities markets are anticipating, but a lot of house hunters out there were hoping on.
Well, the bond market has already adjusted in anticipation of the September rate cut and more rate cuts in the later months, and also going into next year. So definitely we are in a downward trend in mortgage rate. Housing sector, always one of the most sensitive to the mortgage rate changes. And consequently, mortgage rate today at 1-year low level, at under 6.5. We have not seen this for the past 12 months. Very good news. Moreover, more inventory means more choices for consumers. This is going to lead to a lot of dynamism, more sale of a home, more buyers coming in, more sellers listing, all good news.
What do you think the magical number is? Where are rates going to need to come down to in order for people who are perhaps sitting on their homes right now and waiting to refinance? What do you think that number is going to need to come down to on the rates for it to make sense for them to refinance, list them homes, and then putting more supply in the market?
We have to remember during the past couple of years, the mortgage rate have been above 7%. So as the mortgage rate have come down already, we are seeing that revival of some refinance among those people who recently purchased in the past couple of years. But of course, we know there are many other people who have already refinanced into even lower rates, or people took that 3%, 4% rate during the early months of the COVID period. But the key question is whether people who are locked in onto those low rates decide to list because their life is moving on for the better jobs. Maybe they're looking for better school district. Maybe they have additional child in the family wanting to trade up, or maybe retirees wanting a better retirement life by downsizing. So all this pent up potential sellers, I think, will steadily move into the market as mortgage rate decline. Of course, it's not a 3%, 4% mortgage rate, but it is a positive development for the real estate.
And certainly with that in mind, as we're kind of keeping tabs on new and first-time home buyers, what do you think is going to be the critical shift that we see in this new crop of home owners and what they're looking for, and ultimately what that means towards migration shifts even as they're getting into those first-time homes?
Americans view their part of their dream as owning part of America, home ownership. But the overall migration trend has been that from the northern, colder state, people moving into the southern states. So the Carolinas, Georgia, Florida has greatly benefited from this trend, and I think that will continue. And from California's migrating into Rocky Mountain states of Arizona, Nevada, Utah, and Idaho. And I think this trend will continue into the future. But the key is staying within budget. Home builders in the past couple of years, they stopped building those mansions. They're focused on more affordable priced home. That's why they're clicking on the home sales. And the inventory situation beginning to loosen up, more choices for buyers.
All right. Well, as of right now, and based on the most recent reading, median existing home sales price elevated 4.2% from July 2023. That coming in at about $422,600, 13th consecutive month per your readings of month over month or year over year gains. Lawrence, it's always a pleasure to get some of your insights, some of your time here. Lawrence Yun, who's the National Association of Realtors Chief Economist. Good to see you.
Thank you for having me.
Certainly. Coming up, everyone, we've got more Yahoo Finance on the other side of the break. Wall Street getting a boost off optimism here on the path of rate cuts here. Fed Chair Jerome Powell saying the time has come for the central bank to begin lowering interest rates. For more on what this means for your portfolio, let's get to eToro U.S. investment analyst Brett Kenwell is joining us now to discuss. Brett, I just want to get your read through on what we heard from Fed Chair Jerome Powell and what that means for people's portfolios as they might be taking stock of exactly the assets that might need some rotation.
Yeah, thanks for having me. And, you know, when it comes to Chairman Powell's remarks at Jackson Hole this morning, I think he delivered exactly what investors were hoping for. He provided clarity where the Fed stands with its monetary policy. He said, basically laid out the path to cutting rates in September. And at the end of the day, that's exactly what investors wanted to see. I think maybe there was a little bit of hope that he would tip his hand in terms of, you know, the size of the Fed's first rate cut. But that was a long shot. I think everyone reasonably knew that was a long shot. And, you know, outside of that, he delivered exactly what we needed to hear today.
With that in mind, I mean, is there, as we've continued to try and figure out what a Fed cut rate or a Fed rate cut policy playbook looks like for investments, we also heard earlier today that there's a rolling recession type of playbook that people should be right to have in their back pocket as well. What does that really entail from your perspective?
Well, that's an interesting question. You know, when I look at the market presently, I look at it in sort of different time frames. You know, in the short to medium term, there's clearly some headwinds, there's clearly some uncertainty, and that extends beyond just, what investors are thinking about in interest rates, but it extends to, geopolitics overseas. It extends to, even the shakeups we've seen with the presidential election here at home. So, when you kind of consider some of these factors, and now we have, which is an even more important factor, some worries over the economy and over the labor market, which has clearly softened, but I would be hesitant to say that they've been weak. That's sort of the biggest concern at this point moving forward. We do have clarity from the Fed, which came today, which I think is a good thing. But short-term wise, we do have some sort of concerns. There's uncertainty, but when it comes to the long term, the foundations for this bull market are still in place. The earnings growth from the S&P continues to come in strong. We're on the verge of double-digit earnings growth for Q2, which is the best quarterly growth we've seen since Q4 of 2021. Expectations for 5 of the next 6 quarters call for double-digit earnings growth, which that and monetary policy are the driving factors for equities. So I think the big picture is still in place for bulls.
So with that in mind, I mean, this is what the market was craving, and you put this in your notes as well. So if this is what the markets were craving, then now what are the places, the sectors that investors should expect to outperform now that we've got this pivot?
That's a good question. I think it would be reasonable if we saw some sort of mild pullback or a pause in the equity markets, based on the idea that we came into August really abruptly. We had a big pop in volatility. Equity markets pulled back really hard into the low we saw on Monday, August 5th. Since then, we've had a really, really big rally. The S&P's back within 1% of its highs. It's up 10% in less than 3 weeks. It's a very robust move. So it would make sense if we had a little bit of a consolidation period, especially with the headwinds I mentioned earlier. And as we go into September has historically been we look back over the last 10 years has been the most difficult month for the S&P. So it wouldn't be surprising if we had some potholes along the runway, but it's still a long runway, I think. And when I think of it, rates moving lower, I still go back to the groups that do well with falling rates, which would be small caps. I think are poised to do well. Utilities and real estate have been 2 of the best S&P sectors so far this year, on the back of the idea that the Fed is going to lower rates. So I think, and even tech, tech kind of gets lumped into the mega cap names, which are probably a little less rate sensitive due to their immense cash flows and their strong balance sheets, but particularly when we look at high quality, high growth tech that is more sensitive to interest rates. I think some of these names are what could really benefit over the next few quarters.
Brett Kenwell, who is the eToro U.S. investment analyst here. Thanks so much for taking the time. Appreciate it.
Yeah, thanks for having me.
Certainly. Coming up, we've got more coverage out of Jackson Hole, Wyoming. But first, NVIDIA reporting quarterly results next week. Here's a preview of what to expect.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say NVIDIA is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to NVIDIA's boom with Beyond the Ticker, where we dive into the company's biggest moments. NVIDIA was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, NVIDIA launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, NVIDIA went public via IPO at $12 per share. And in 2000, Microsoft chose NVIDIA to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose NVIDIA's hardware to power the PlayStation 3. In 2010, NVIDIA became the graphics chip supplier for automaker Audi. And in 2015, the company launched its NVIDIA Drive chip for powering driver assistance technologies. In 2016, NVIDIA kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted NVIDIA RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using NVIDIA's Tesla P4 graphics cards for its Google Cloud platform. In 2022, NVIDIA debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, NVIDIA eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, NVIDIA remains at the top of the tech industry.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Stocks are higher after Fed Chair Powell said it's time for rate cuts. Yahoo Finance's Jared Blickery has a better look at the markets right now from the Wi-Fi Interactive. Hey, Jared.
Hey, Brad, let's go to the well, we are at the Wi-Fi Interactive. Let's go to the S&P 500. All these squiggly lines here. This is what happened basically since 10 a.m. We got this jolt up, then we had the speech, came down afterwards, and now we're up again. But the important part is that we are back up to the highs of the week. And let me tell you, and first put some candlesticks on here, why that is important. Because yesterday, this is a 2-month chart. I'm going to show this for a minute first. We had a bearish engulfing, and today is the test of that. If we can break higher, if we close higher than yesterday's high there, that's very bullish in the short term. So this is what stocks are trying to do. And sometimes long-term trends, well, they have to start somewhere. This could be the beginning of a reversal. It could be a continuation to the upside. But this is the battleground right here in the S&P 500. Now, if we look at some of the other markets, which are not quite as determinative, here's the Dow. It is at its highs of the week. It's very close to its record highs from just a couple months ago. And let me just leave you on the VIX. VIX is down today, but I've got my eyes on this like a hawk. Definitely want to keep track of volatility. Now it is 16, guys.
All right, Jared, thanks so much. We've got much more coverage as well of the Fed's Economic Symposium. Fed correspondent Jennifer Schonberger standing by with former Fed Vice Chair Alan Blinder. Jennifer, take it away.
Thanks so much, Brad. Professor Blinder, thanks so much for joining me here in Jackson Hole. It's great to have you in the program. You heard Powell's speech this morning. They're going 25 basis points in September?
That would be my guess. Now, we still have almost 4 weeks and something unusual could happen. I don't expect, by saying something unusual, it means you don't expect it to happen. Assuming nothing like that happens, that's what I would guess.
You penned an op-ed in a Wall Street Journal back in July. You thought the Fed could have cut rates in July. Since then, we've seen inflation continue to come down.
Right.
The job market soften a bit. Do you think the Fed's behind the curve?
Yeah, I think they're a little behind the curve, but we don't want to exaggerate this too much. That was the last day of July, the last meeting. And what are we today? August 24th? So not that much time has gone by, and there are a few more weeks to the next meeting. So I'd say they're a little bit behind the curve, but not drastically.
Have the chances for a recession increased as a result?
Doesn't look it. It's hard to remember back and exactly how did the data look in the middle of July. I don't think it looked very different from it does today. There are a lot of numbers on inflation, on consumer spending, on production and so on. If you put them all together, I think the economy looks pretty similar now than it did then, which of course is one reason why I was back then, advocating that they should cut interest rates.
But what about the job market? We've seen the unemployment rate jump up. Yes, it's because more people are entering the labor force, but typically when you've seen the unemployment rate jump by 0.5% from its low over the past year, we've seen the unemployment rate jump a lot more, and the economy has been in recession. So can the job market continue to cool without a recession?
Not too much more. So the literal answer to your question is yes, a bit more. But if it's been going up smoothly, actually, in the last 4 or 5 months at 1/10 of a point on unemployment per month. You don't want to keep that up for very long. I mean, if you do that for a year, you're up 1.2 percentage points.
And that's why Powell probably said the Fed is prepared to do what is necessary to make sure that the job market doesn't weaken further, right?
Yeah, he used that phrase. He doesn't want it to see it weaken further. Now,
so then what does that mean for the policy path as we go through the fall here?
It means that I think it means that interest rate cuts start right away at the next meeting. It means that if the labor market should deteriorate more than he and the Fed now expect, there could be an acceleration of the interest rate cuts. Start doing 50s or something like that. If not, I think what they're hoping for is that the unemployment rate peak is not very far off, that we're very close to it, in which case you can move at a deliberate pace and not give off the aura of, oh my God, we missed the boat and we better get on the boat quickly before it sails away.
So how many cuts do you think we're going to see this fall?
In the fall, 2 or 3, I think.
So we could go possibly every meeting then, it sounds like.
Yeah, there aren't that many meetings left.
Right, we've got 3 left.
Go ahead.
Before I let you go really quick, Donald Trump has said that the Fed should not cut rates before the election, clearly going to be cutting in September. He's also talked about the president having a say in setting monetary policy. Your response to that?
The president has a say in setting monetary policy exactly as he or she should under our current arrangement, which is that he or she gets to put people on the Federal Reserve Board. These are presidential appointees, and that's great. And by dint of that appointment power, any president and a succession of presidents exercises very gradual influence on the Federal Reserve. In the language that we all use now, they put more dovish people or more hawkish people as they want. That's not what Donald Trump meant.
Well, unfortunately, we're going to have to leave the conversation there, but Professor Blinder, thank you so much for your insight. I so appreciate it.
You're most welcome.
I hope to speak with you soon. Brad, I'll send it back to you in New York.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Welcome back to Yahoo Finance Live here in Jackson Hole. I'm Jennifer Schonberger. Fed Chair Jay Powell made clear that the Fed is set to cut rates next month, saying the time has come to adjust policy. For more on the Fed's future moves, I want to welcome into the program Patrick Harker, president of the Philadelphia Federal Reserve. President Harker, thanks so much for joining me. It's great to have
Jennifer,
you.
Great to be here.
Good to see you.
Yeah.
So we heard from Fed Chair Powell. He says the time has come to adjust policy. You're going 25 basis points cut in September?
We're starting a process. We will let the data dictate 25 or 50, but the process in my mind is more important than the actual number. Now, why do I think that? So I've been out in my district a lot this summer, talking to business leaders, bankers, community leaders. And the one thing I heard is be methodical, right? It was hard for us when you took them up very fast. We understand why you did it, but that was hard for us to absorb. When you start this process of cutting, do it in a methodical way to give us time to absorb it. And they care less, honestly, whether it's 25 or 50. It's the process, just getting it moving in the right direction. And I think the right direction is clearly down.
And so what does that look like? Are you going every meeting? Are you going every other meeting? What does the policy path look like?
It really depends on what the data, there are still risks out there in the economy. So we need to be cognizant of those risks. But in this case, I think starting with 25 makes a lot of sense to me, and we'll just see how this plays out.
What would put a 50 basis point rate cut on the table for you? Is it another weak jobs report? Is it more than that?
Not just a weak jobs report, but weak job data. I am firmly in the camp of not looking at any one number, because we know these numbers can be revised, and you have to look at all the data, claims data, job-to-job transitions data, the soft data we're hearing from employers throughout our district and throughout the country. Right now, things have clearly softened in the labor market, but they're still strong. I mean, the average that we've had over 170,000 jobs over 12 months, even with the revision. Go back to 2019 and think about what that number meant back in 2019. Very good number. So we need to look at all that data. And again, if we saw a substantial change in the labor market to the downside, then I would be open to a larger cut, but not right now.
And that would probably increase the pace of cuts, right?
Yeah, it probably would. But right now, that's not in my forecast.
On the job market, though, we have seen the unemployment rate jump up by 0.5 percentage point from its low over the past year. Granted, it's been up a lot because a lot of people are joining the labor force.
That's right.
Nevertheless, historically, when we have seen such a move, the unemployment rate has jumped a lot higher and the economy has entered recession. So can the unemployment rate continue to go up without a recession?
I hate to keep using the word unprecedented, right? But it's true. Where we are right now, we can look at history as some guide, but it's not the guide. And right now, what we're seeing, you think about what we went through. We've done a lot of catch up in the labor market. You think about government employment. A lot of people have joined the government. But in terms of a percent of overall labor market, it's back to around 15%, where it was before the pandemic hit. So we've done a lot of catch up. And there's some catch up to do still in areas like healthcare. We're seeing, it's still a lot of openings in healthcare. But I'm not that concerned right now that the labor market is in some way in trouble. I don't see that at all. I think we still have a very robust labor market.
What's your view on immigration when it comes to boosting labor supply in the labor market as well as U.S. productivity?
No, I mean, it's added clearly to the labor market, to, as you said, to unemployment. But those people we know are getting employed in various ways. So no, it's clearly added to the labor market. It's one of the reasons we've been able to come out of the bad situation we were in so quickly relative to many other parts of the world.
In the Fed minutes, it was clear that several officials thought the case could have been made for a rate cut in July.
Yeah.
Were you of that mindset? There's some who say that perhaps the Fed is a little bit behind the curve.
Yeah.
What's your sense?
I don't think we're behind the curve because, again, it's about process, not particular numbers. Look at the longer end of the curve. Look at the 10-year, the 30-year. It's already moving in the direction we want it to move in. And so I don't think we're behind the curve at all, no.
You're looking to cut rates for the first time in 4 years.
Right.
As you look back, what lessons have you taken on the dynamics of inflation as well as the job market?
Yeah, I can only speak for myself, but the one thing I've learned, we early on started to think that inflation wasn't as transitory as many others thought. And we started to see that. And how did we start to see that? In the soft data that we were getting. The hard data was still not showing the problem that we eventually had to deal with. But the soft data we're starting to hear from our contacts through surveys, but just conversations, started to say, look, it's worse than you guys think. The lesson I learned is to take that soft data more seriously than I did. I always took it seriously, but I think particularly in an era where the data, particularly survey data, is difficult, as we know, because people aren't responding to the surveys, we need a host of different data sources to paint a picture. And so that's the lesson I learned, is to pay more attention to that soft data. And what I'm clearly hearing now, and I've heard now for a while, is that we need to start bringing rates down in this slow, methodical way.
Fed Chair Powell has been fervent about the need for central bank independence to make policy decisions that best serve the economy without political intervention. Former President Trump has said he thinks that the president should have a say in setting monetary policy. He's kind of backtracked a little bit from that this week, but your response to that?
Fed independence is crucial. All you have to do is look through history. You can look through American history, look through what's happening in some countries in the world today to see examples of when that independence, that wall of independence is breached. Bad things can happen. So I am adamantly in the camp to maintain the independence of the Federal Reserve.
Before I let you go, President Harker, you say the path is down now. What's your sense of the economic outlook? Is the soft landing in place?
I think the soft landing is most probable. You can never guarantee anything, right? But I think right now things look pretty good.
President Harker, thank you so much for your insight. I so appreciate it.
Thank you.
Hope to speak with you again soon. That's Philly Fed President Patrick Harker. Brad, I'll send it back to you in New York.
All right, thank you so much to our own Jennifer Schonberger and Philly Fed President Patrick Harker. Appreciate it there from Jackson Hole, Wyoming. Don't miss our continuing coverage of the Fed's annual economic symposium. In the afternoon, our Fed correspondent will have sit-down interviews with Atlanta Fed President Raphael Bostic, IMF Chief Economist Pierre-Olivier Gourinchas, and White House Council of Economic Advisors Chair Jared Bernstein. Let's do one final check of the markets here as we're taking a look at the Dow, the S&P 500, and the Nasdaq, which have been in rally mode after Fed Chair Jerome Powell's speech in Jackson Hole. You're seeing the Dow, the S&P 500 hold on to those gains as of right now. The Nasdaq leading the charge on a percentage basis, up 1.2%. We'll round that off too. Well, that's it for this special report. I'm Brad Smith. Thanks so much for watching. We have much more Yahoo Finance for you this afternoon.